Okay, thank you. Thank you. Are you sure it works? Oh, yeah. So it's a pleasure to be there. I understand, you remind me that it is for the 10th time. I'm impressed. We were only eliminated, if I may, in the time of the COVID, probably. And so it's a pleasure, a real pleasure for me to be back with you and to be impressed by the multi-layers, multi-country audience that we have here, which is quite extraordinary. And I'm also proud that we are in the Sorbonne. And I think it was a very good idea to have the meeting in the Sorbonne. So I'm totally in your hands, of course, as regards the duration of the seminar. I know that you gave me very generously something like 3/4 of an hour. I will try to stick to the 3/4 of an hour in order for the questions to be as, I hope, as frank, direct, incisive as possible. It's, the interest of the question and answer session is great for me. I learn a lot from your questions, and I hope that you learn also a little bit from my responses. So I will speak on the challenges for monetary policy seen now, of course, and now means after the illusion of inflation being totally eliminated, after the surge of inflation, and after the hard work of the central banks everywhere in the world, I have to say, to try to cope with this situation and to deliver again price stability. I will conclude on one of the element of the conclusion will certainly be that we should never forget that in delivering price stability credibly over the medium and long term, we are working for the poorest and the most vulnerable part of our societies. Don't trust those who say inflation is very good, very agreeable, you can do a lot of things thanks to inflation. We do not think, we central bankers, we do not think at all that it is true. And we know by experience that our own fellow citizens are hating inflation, even when we are mastering the period, the relatively short period of inflation in the most recent period of time. But what is absolutely sure is that you have two compartments in our population, those who have the capacity to prevent themselves from the hardship of inflation, and those who cannot. And those who cannot are the most vulnerable part of our society. So I really stress that. Now I will try to embark on my exposition. And speaking of monetary policy, I cannot help remember the story of Alan Greenspan. I worked with Alan because we were both president of our central banks at the time. And you know the story, it is very well known. He was asked, as usual, to deliver his hearings in the Senate of the United States of America. And one of the questions from a senator was, Mr. Chairman, could you tell us whether you will increase rates or decrease rates in the next meeting of the Open Market Committee? And Alan said, Mr. Senator, it's a very complex question, very, very interesting, stimulating, complex. We have to look very carefully at everything in the economy at the present moment. We have contradictory indicators, so we have to be very cautious and prudent. That being said, don't forget that on top of all what is very well known, we have the inventories. And as you know, Mr. Senator, it is the second derivative of the inventories which contributes or not to growth, which is so, of course. And he continued, he went on for 20 minutes. And the senator at the end said, I understood, thank you very much, Mr. Chairman, you will decrease rates in the next meeting of the Open Market Committee. And then Alan Greenspan was blank and pale. It's a story, but it's true. He went blank and pale, and he said, oh, Mr. Senator, if you think you have understood what I just said, I probably made a mistake somewhere. and it was a good way of indicating at the time that the central bankers had to be as enigmatic as possible, as obscure as possible, and as unpredictable as possible as regards their next decisions, which is not the case anymore. We change drastically the, I would say, understanding of what was good or not good in terms of delivering the best monetary policy, transparency, and I would say credibility in and I would say appropriate understanding of what the central banks are saying is now part of the game. So in the next 3/4 of an hour that I have, I will embark on trying to understand with you how inflation disappeared. What was the reason for inflation to disappear after the great financial crisis triggered by the collapse and the bankruptcy of Lehman Brothers. Then I will try to understand why inflation came back with a vengeance in the time of the COVID, I would say at the middle of the COVID experience. Then I try to say a few words, and then the modeling, the dynamic stochastic general equilibrium model are at stake because they are part of the difficulty we have. I'm very happy that you're reflecting a lot on how to introduce new models, even if it is not a question of demolishing the models as they are, or not trying to elaborate more on them and perfect them. But clearly we have a big problem, particularly in these times where you have a very rapid changes, very rapid transformation of the economy, of finance, of the monetary evolution. And experience has demonstrated clearly that then we could not rely upon the dynamic stochastic general equilibrium model only, that we had to introduce new elements. I will also elaborate a little bit on that. And then I will more or less terminate the exposition in explaining why I am personally convinced, despite still a lot of skepticism in various compartments of the public opinion, of economy, that the central bank will be able probably to deliver price stability according to their definition of what is price stability in the medium term. The long term, we will see. In the long term, we are all dead, of course, as said the Keynes. But in the medium term, I really trust that we will have a success, if I may, of the central banks in trying to restore price stability. And then I will conclude with some messages. So first, inflation disappearing. Maybe you're too young to put yourself in this, I would say, mental environment, but there has been a time where it was absolutely common belief that inflation was not a problem anymore, and that we won't hear anything on inflation. It was after Lehman Brothers and in between Lehman Brothers and I would say the new surge of inflation in the time of the COVID. So this, what can explain with the, I would say, hindsight, the reason why we had such a strong belief that inflation had disappeared. I see several reasons for that. I listed 5 reasons, crucially. One is there was a good reason for that, the scars of the global financial crisis. The global financial crisis, Lehman Brothers bankruptcy, the free fall of the economies the world over, and particularly, of course, on both sides of the Atlantic, the dramatic period. We had a good reason, in my opinion, for inflation was being extremely low, and even I would say with all close attention to what happened at the time, my conclusion is that it was not abnormal but normal that we had, even if paradoxically we had a downward revision of the potential growth over the period, still the scars were there, and we had this element, this contribution to very low inflation. Second reason, we had the acceleration of globalization. We were experiencing a period where the idea of having extended global I would say, value-added chains was something which permitted to decrease costs as much as possible. Decreasing costs, of course, you were decreasing risks, and you were decreasing also at the time the prices. So you had a very powerful element of globalization which was accelerating after Lehman Brothers until the COVID. A third reason, I said that I had 5 reasons. The third reason was the weakening of the labor force, the labor influence, the bargaining power of labor unions, of trade unions in all advanced economies, and particularly in the US, was absolutely striking. Organized labor was progressively put in a situation where they were not expecting, I would say, augmentation of wages and salaries in real terms, at least for those who were not very well educated, who were at the close to the bottom of the worker, I would say, graduation, if I may. And that, of course, played a very important role, because inflation is very closely correlated with changes in unit production costs. And when you combine productivity gains and very, very mediocre augmentation of the nominal wages and salaries, the result is that you have a stagnating unit labor cost, at least for that category of production. And then, of course, you have very, very low inflation. Another contribution was at the global level, the so-called global savings glut, namely the idea that at a global level you had an excess of savings in comparison with, say, global investment at the level of the entire planet. And that, of course, was playing a role in pushing down the interest rates, because you had the supply and demand functioning for this savings and investment on the one hand. And also, of course, he played a role in pushing inflation down. And this reasoning is at the level of the entire world. Of course, at the level of the US, as you know, the US is permanently in current account deficit. Lack of savings is permanent in the US, so you cannot argue in taking the most important advanced economy that there is an excess of savings. There is a lack of savings in the US, but all taken into account, it seems to me very well documented economically that we had at the global level. It's not the case anymore, in my opinion, but we had at the global level, during a long period of time, this element of excess of savings. And the fifth reason I could mention, that the COVID itself was, in the first period of the COVID, playing a role to amplify even more the situation, with a permanent threat of synchronized implosion of national and continental economy, as well as the global economy. So the central banks had, at the beginning of the COVID period, even more to care for preventing all our economies and the global economy from the materialization of the deflationary risk. And you know what deflation means. Deflation is the contraction of all prices. It calls, I would say, investors, entrepreneurs, households to wait for prices to be even lower before embarking in their decisions of investment, decision of consumption. And of course, it contracts the economy dramatically. To understand exactly in which universe central banks were, I must say that it was not in my case, because I left the central banking constituency at the end of year 2011. And we were not yet in this period where the materialization of deflation was the most dramatic situation which my successor had to know, and my two successors had to understand, know, and combat against. So you see, we were in a period where inflation was extremely low for good reasons. You could add, I don't pretend that I am exhaustive in mentioning all the reasons I have been already mentioning, but it's, there were very good reasons. This idea that the materialization of the deflationary risk could be very dramatic was for real, in my opinion. Some are criticizing, saying, well, it was a fear that had been amplified, and they should not have embarked that, I would say, resolutely in extraordinary monetary policy measure like zero interest rates, negative interest rates, QE, generalized QE, quantitative easing, and so forth. I don't criticize this period. I think that on both sides of the Atlantic, in Japan, everywhere in the world, those who had the capacity to embark on very imaginative, creative, and I have to say, extraordinarily accommodating policies were justified to do that by the situation. So we had a very long period of extraordinary, a period which was without any precedent of extraordinary accommodating monetary policies practiced by the central banks of the advanced economy that had some maneuvering to do that, central banks of the emerging economies when they had the appropriate room for maneuver, and I would say central banks all over the world. Again, materialization of the deflationary risk was really the major problem. So what can I say? I promise that I will elaborate of the reason why inflation came back with a vengeance. And it started with the recovery in the period of the COVID. So I would call that the post-COVID recovery. The post-COVID recovery was very unexpected, if I may, as a major cause, a major trigger for inflation, but it was really, obviously. And when we had simultaneously the supply and demand being in a totally different position, because before they were both suppressed, if I may, by the COVID, and then you had demand being alive, again with a vengeance, helped also by all the, I would say, expansive fiscal policies that had accumulated the capacity for all economic agents in most advanced economy in particular to be able to consume again or to invest again. But on top, as regards this demand, which was back, if I may, with a vengeance, as I said, you had supply, and supply had still the scars of the COVID period. So you had a very simple, very well-known element of inflation, supply and demand. Supply was insufficient to face up the demand, which was back, and you had this start of inflation. So I don't elaborate too much on that. The mismatch between the strong demand and insufficient supply of goods and services can be dated approximately in the first half of 21 on both sides of the Atlantic. I concentrate a little bit on the major, I would say, economies of the world, putting China, which is a very special case, apart at this stage. And so we had on both sides of the Atlantic the same phenomenon, approximately the same period, perhaps a little bit in the US before what was observed in Europe. That is really the trigger, and I would say the first cause for what I will elaborate on, out of 8 causes. So number one, this post-COVID recovery. Number two, there was, and I will go back to that, some long hesitation of the overall authorities in general, executive authorities, governments, central banks, waited before taking the appropriate decisions. The delay of, I would say, 6 months or even a little bit more than 6 months was, of course, with the benefit of the hindsight, regrettable. It was a mistake to wait for so long. The emerging inflation met with no immediate response in terms of monetary policy. I will spend a little time to try to understand that. The modeling is part of this difficulty. Not the only one, but part of this difficulty. A third reason why we had this surge of inflation, and a surge of inflation which was durable and not only transitory, was the extraordinarily accommodating, expansive monetary policy over all the period of more than 10 years between the two crises, as I said, Lehman and COVID. And of course, this was accumulating, with the QE in particular, an enormous amount, an enormous stock of central bank money, of base money, with the accumulation of commercial bank reserves in the books of the central banks. So I don't insist too much on that. Many are saying this is the cause of the surge of inflation. You were much too accommodating in this long period of 10 years before the surge of inflation, and you pay a price for having been too much accommodating, for having been too, I would say, insensitive to the potential inflationary consequences of your monetary policy. I don't buy that, but I have to mention it as, argued by a number of economists, academics, observers, even market participants. The fourth reason is the symmetric in the policy mix of the very accommodating monetary policy, namely the fiscal policy that were extraordinarily accommodating for the same reasons. I explain why the threat of materialization of deflation considered as the main risk was triggering very accommodating monetary policy. It was also triggering very accommodating fiscal policies for the same reasons. The policy mix was entirely designed to prevent the materialization of deflation. So that was the fourth reason that I can list. And again, I don't pretend that I am absolutely exhaustive. The fifth reason is the symmetric of what I already said on globalization. Globalization, acceleration of globalization was explaining very much what we had observed in a period of very low inflation. The deceleration of globalization, which was a consequence, a complex consequence of the COVID, of the realization by many that they were depending for medicine, for a lot of, for the masks and so forth, on other production in countries that were far away, that the fact that they were themselves, these countries, these potential suppliers, real suppliers, were in the COVID turmoil, turbulences, and that they could not deliver the components that they were used to deliver, and so forth. Plus an element of geostrategic tensions that was also very visible at that time, was creating a new attitude towards globalization, the sentiment that this very long-term and I would say extended global value chains were too much, and that the hedging against the risk associated with this very long chain of supply was of great importance. And you can see that in the public discourse everywhere, I would say, in the world, particularly in the US, where this idea of reintroducing in the US a lot of production that were considered appropriately coming from outside is very, very strong. The French policy is very strong also, at least in the rhetoric, in this respect. And you have the same phenomenon the world over, amplified by, as I said, the, not only the COVID lecture of what had happened, but also the geostrategic tensions everywhere. So there we have, we are really now in a new universe, which is a more long-term, of course, universe, which is not transitory by definition, which might be of, I would say, long-term, medium long-term period. And of course, it plays exactly the reverse role that I have already mentioned to explain moderating prices. It obliges these prices to go up because the cost of repatriating a lot of production is pushing prices higher, costs and prices higher. Now, the sixth reason I see, which is also of a structural nature, is the fact that there has been seen from, you know, in a global perspective and in a medium-term perspective, this major reverse of the attitude of our fellow citizens, at least in the democracies, but I think you observe that phenomenon also in the emerging economies, certainly in Latin America, certainly in China, where the middle man and middle woman in the production process does not accept anymore to be treated as it was the case in the previous period. So I see something which is very important in terms of, I would say, synchronization of the various countries. You have the case of the United States of America is very, very interesting. You could see the Republican Party, which was the party of the big business, becoming the party of the blue collars. Trump is a dramatic change. He has triggered a dramatic change in the political framework of the United States of America. Whether he will deliver or not is another story. Whether the blue collars will be deceived or are deceived by Trump is another story. But the fact is that they elected Trump. And you have exactly the same phenomenon in many other economies, as I said, not only advanced but also emerging economies. And that is something which is of a structural nature, exactly as structural, it seems to me, as what I mentioned on the long global value chain is structural. And we will see, of course. I don't want to commit myself too much, but I was amazed to see these changes. And I think that what was considered before, and I'm speaking at economists, as a curious economist, I would say, phenomenon that had to be explained by economy, namely that because they were not, I would say, appropriately educated, a lot of people had to be content with absence of augmentation of their wages and salaries and be content with a very, very, I would say, strong benign neglect vis-à-vis their contribution to participating in the growth of the economy or the growth of the continent or the global growth. That is changing and has changed in the United States. In this respect, the United States seems to me to be revealing a phenomenon which is of a great importance. It was my sixth, if I'm not misled, reason. Now you have a seventh reason, which is the green transition. So I don't insist on the green transition because you had already, if I understand well, 2 hours of green transition today. So but it's clear that the green transition has a cost. And this idea that there is no cost associated with the green transition because you gain, it's a win-win game, you please the planet, you please the future of our fellow citizens and of our children, and at the same time you create new jobs in various areas. it's a nice story. I understand that many governments are more or less giving as much as possible authority to this story, but the fact is that you have to invest much more in some domain, that you have to get rid of a stock of investment which appears to be, I would say, obsolete because of the green transition. So it's clear that from that standpoint, at a global level, if, of course, we respect what is the present consensus, and that is a question which is also disputed, of course, but if we respect the present consensus, it has a cost. And the cost will be both exactly the reverse of the previous cost. The global glut of savings would be transformed in a global lack of savings because investment would be very big and necessary. And then, of course, you have both real interest rates pushed higher, and you have also, and it's very natural, you would have the phenomenon of inflation because the demand, global demand, would be superior to what it was before. So both phenomenon, inflation potentially pushed up and interest rates pushed also, real interest rates pushed also up. This was my seventh cause, potential cause. As you see, the three last I mentioned are of a structural nature. Before it was more conjunctural or in between conjunctural and structural when I looked at the accumulation of accommodating policies in the past. But three are really structural, and it is because of these three structural reasons to have inflation higher in the future that many are very skeptical vis-à-vis the capacity of the central bank to counter this potential pressure and be able, nevertheless, to deliver price stability as far as they see it. I could have mentioned at the very beginning, I can mention at the end, but the last reason I did not mention, which is very important for the European, much less important perhaps for the US, is the war in Ukraine. War in Ukraine had a very, very important element of inflationary impact because, of course, the European had access to low energy costs, particularly Germany, but all the European, and that has dramatically changed, which is not the case of the US. The US is self-sufficient as regards energy, and on the contrary, I would say they benefit from the rest of the world asking for more liquefied gas and. So there you have a particular handicap for the European, I have to mention, not only on the inflationary aspect of it, but more simply on growth in Europe. Growth in Europe is much more handicapped by what happened in Ukraine than in any other country in the world, and certainly than the US. And of course, what I said on energy is particularly flagrant, it's obvious, but food also has been impacted. It's clear that the Europeans are not self-sufficient also in food, and the prices of food, particularly of cereals, had been pushed up at a time. I mean, it's complex, you have variation of the prices. But as you know, we have very complex reasons to think that this idea that there was no inflation anymore, and I could present you a long list of academic work that were definitive on the fact that it was a total mistake to think that we could have any problem with inflation in the future, that inflation was out of the game, and that it was a bizarre attitude of some central bankers to think that they still had to reflect on how to deliver price stability. Now, I told you that I could say just a few words on the reason why there was a little time taken before accepting that inflation was not transitory anymore, but that it was for real and more of a medium-term nature, and perhaps medium-long term if appropriate decisions were not taken. So I only mention that Jay Powell, the chairman of the Federal Reserve, was still saying in October 21, several months after the pickup of inflation, that the inflation was seen by the Federal Reserve as transitory. And he said that he was pretty sure that getting back to price stability around 2% was very likely in the course of 22. With the benefit of the hindsight, it seems extraordinary to say that. And to the extent that I think that Jay is a very good man, and that he was full of PhDs of extreme quality in the Federal Reserve, that meant that the model were not functioning correctly. And we are back to what you are studying very carefully, rightly so. And there you have a splendid example of the fact that the dynamic stochastic general equilibrium, as they were constructed, were not at all helping the decision makers. And I had the same experience, you mentioned it, myself, in the time of the collapse of Lehman Brothers. The models that we had were not capturing at all the fact that the real economy was falling like a stone, and that we were in a totally different universe. We were 2 standard deviation when I was looking at all the modeling out of the realization that we could observe ex post. So there is really something which has to be understood much better. But in any case, that was one of the reasons why I think we have to be very careful when we embark in period of very rapid transformation, very rapid changes, on only to rely on one set of models. You must have the kind of robustness that you were mentioning, adding several models. I would hope at the time myself that we could make a lot of progress in models that were inspired by physics, and that some work is being done. But unfortunately, nothing is really totally convincing. But it's clear that when you have to understand these periods, the models of the phase transition, how water becomes vapor and or be transformed into ice, all this rapid transformation are part of what we are observing in the economy, finance, and I have a number of examples on this particular these particular phenomena. So another element, of course, which can explain the late decisions was perfectly respectable. The idea that it is essentially a supply shock, that we had to understand that to the extent that it was essentially a supply shock, it could be transitory. I think this reason is perfectly respectable, and of course it was totally, I would say, present in the modeling. The idea that we could have a demand shock, and a real demand shock, appeared to be less likely, or less with less authority, if I may. There was the common belief amongst many economists that in any case, it was not because we had the period of the COVID that all the explanations for very low inflation in the past were not valid for the future. And there was also, I would say, elements that were associated with the monetary policy of the central banks themselves, of the, I would say, the forward guidance. The forward guidance in the time of very low inflation and materialization of deflation being the main danger, of course, you had to say, whatever happens, we will continue to be extremely accommodative. And that was pushing market participants and I would say all economic agents to think that it was serious when the central banks were saying that they would be extremely accommodating, a good way to avoid deflation. Of course, if inflation comes back with a vengeance, you're trapped, because you had said that whatever happens, we will continue to be accommodating for a long period of time. And it was even amplified by the fact that there had been an association by many central banks between the, I would say, standard monetary policy, namely interest rates, and non-standard monetary policy. And in many cases, on both sides of the Atlantic in particular, it was said we will increase rates only after we had eliminated the net impact of QE. And of course, to the extent that elimination of net impact of QE was also trapped in forward guidance, then you were prolonging a period of very low interest rates, in my opinion, of course, for a too long a period of time. So I conclude on that. There was many reasons why we were late in the augmentations, appropriate, I would say, strengthening of monetary policy. The Europeans were a little bit later, which can be understood very well because, as I said, the impact of inflation materialized a little bit later in Europe, but also because of the coincidence with the Ukrainian war, which was putting on the economy of the European economy an additional element of, I would say, difficult appreciation of what was exactly the situation. But of course, with the benefit of the hindsight, I take no risk in saying acting 6 months before would have been better, even if what they did afterwards was very serious, very strong. And now I'm on the chapter, if I may, why I trust that what the central bank have done until they started to counter inflation is serious, and why I think we can trust them when they say they will, on both sides of the Atlantic, deliver again price stability. So after their initial hesitation, they were quite serious. The Fed increased rates 11 times with a total increase of 5.25%, which is quite big, including 4 consecutive hikes of 0.75%, totally unprecedented in the US. In the euro area, the ECB increased rates 10 times between July 22 and September 23. Had you asked economists whether it would be thinkable that the ECB would increase rate 10 times during such a short period of time, they would have told you it's absolutely unthinkable. They will never do that. They will never do that in particular because it would have an impact on the fiscal policies of all the governments concerned. It will augment considerably the interest rates that they have to pay. The service of the debt will be much more difficult to cope with and so forth. And they are prisoner of the governments. I must confess myself, I always said, no, you're plain wrong. They have a commitment to deliver price stability. In the US as well as in Europe, they will do whatever is necessary to meet the call. And particularly in Europe, it is unthinkable that they would be a puppet in the hands of the government because there has been a change of treaty and they have a responsibility in this respect vis-à-vis all fellow citizens. But it's the same in the US. The same reasoning in the US was the Fed will never increase massively interest rates. It's unthinkable. And as you could see, they have done that. So great determination of the part of central banks. Second reasons, I would say, I am very impressed, say, by the fact that on both sides of the Atlantic, we had a parallel disinflationary process. I see that in the paper I gave for this seminar, I was not up to date, of course, because it was given before. I give you the last figure. USA, headline December last year, 2.9%, core 3.2%. Of course, we are coming in the US from a peak at more than 10%. 10 down to 2.9 or 3.2. In the euro area, we were close to 10 at the peak, and we are headline 2.4%, core 2.7%. What I draw your attention to is that the disinflationary process has been parallel on both sides of the Atlantic, which is quite remarkable, obviously, with a difference between both core and headline of 0.5%. Only 0.5% difference of inflation, core and headline, on both sides of the Atlantic. It might, of course, think extraordinary that this parallel disinflationary operates, but not that surprising. All major central banks of the advanced economy that are issuing the currencies that are in the basket of the special drawing rights of the IMF have the same definition of price stability, 2% in the medium run. You can call that a target, inflation target, medium-term inflation target, if you are an inflation targeter. You can call that definition of price stability if you are not really an inflation targeter, at least theoretically, which is the case in the US and in Europe. But whatever the definition is, the same figure, 2%, has been affirmed by all central banks. And in my opinion, it explains this extraordinary parallel disinflationary process. When did that appear? I am very proud to say that Banque de France had been the first big bank. New Zealand was a very powerful inventor of the so-called price target concept. But Banque de France was the first big bank to say, when it became independent, less than 2. And 2 was the implicit definition of price stability, in line, by the way, with the disinflationary process, which was called competitive disinflation, and was a governmental position, paving the way for the euro and European construction. But it was adopted at the level of Europe as a whole, so the Central Bank of Europe, the ECB, said less than 2, but close to 2, with the precision being given in 2003. And then, after Lehman, the UK was also saying 2% is the target of the Bank of England. It was the government in the UK saying that, because the government is in the UK responsible for defining the goal of price stability, or the definition of price stability. And then you had, after Lehman Brothers, the US and Japan. The US in 2012 and Japan in 2013. On the ground that in extraordinarily difficult time, where volatility was extraordinary, where unpredictability of what could happen was extraordinary, when the models were not reflecting at all what you would expect and so forth, it was good to try to anchor directly expectations all over the economy. And this is the reason why Ben Bernanke convinced the Open Market Committee and succeeded in convincing the Congress that they were legitimate in saying that their definition of price stability in the medium term was 2%. I draw your attention to the fact that it was very courageous, because the central bank in the US is not independent according to the Constitution. It is totally depending on the Congress. And so the Congress could have said, well, interesting your proposal, but let's look at what is your definition of, I would say, full employment, for instance. Is it 4%? Is it 3.5%? Is it 2%? Do you have a definition? And for very good reasons, the Fed could implicitly and explicitly convinced the Congress it was better to have such anchoring of inflation expectations. The Japanese did the same. They were in a totally different situation. They didn't have to combat inflation themselves, but on the contrary, they thought that mentioning 2% was helping them to have an appropriate, going back to price stability as they see it with not 0, but 2%. So the US and Japan, after Lehman Brothers, the UK and Europe before Lehman Brothers, 4 currencies that are in the basket of the SDR. The 5th currency that is in the basket of the SDR is the renminbi. And as you know, the renminbi was during all this time and is now at a quite low level of inflation. It's a problem, by the way, a little bit like Japan for China. But you see, the world has changed considerably. And of course, having participated myself very actively in this generalization of this definition of price stability, of course, I'm a little bit judge and party, but I try to avoid to say anything, but it is de facto a major change in the international monetary system since the explosion of Bretton Woods, because again, you have the same definition, the anchoring on a particular figures 2%, by the heart, the core of the international monetary system, the big convertible currencies, including the renminbi, which is not yet convertible, as you know, but is part of the overall basket of the SDR. But I don't pretend that it is for eternity. And I know, of course, there are in the academic, I would say, discussions, a lot of criticism. You should not say 2%, you should say 3%. It would give you some room for maneuvering, or 4%, why not? And eminent economists recommended 4%, even at the time of the Lehman Brothers crisis. Some, on the other side, are arguing 0 is not a problem at all. You are amplifying dramatically the risk of deflation, but we can live with 0. Look at a number of countries. Switzerland is more or less permanently at 0, and they live quite comfortably at that level. Of course, they have a lot of benefit associated with extremely low inflation. It augments their own competitiveness. It permits to have very, very low interest rates, even when the other have much higher interest rates, and why not? So I accept all this discussion. I express only my very strong belief that the compromise that was found empirically, but generalized globally at that level of 2% is an extremely good compromise between the necessity not to let inflation change profoundly the functioning of your economy, and by the way, convincing your own people that they are not at an excessive risk of being touched by the, I would say, hidden impact of the inflationary taxation. And that is extremely important. Look, the recent period, I am praising the central bank for what they did to get back to price stability. I take it that they have practically won. Nevertheless, the people is not satisfied at all. Even the short period where inflation was too high is in all memory. It's not impossible that Kamala Harris has been killed by this period. It's not impossible that all the changes of government that we were observing, I'm not speaking of France, we were observing the world over, are associated with the memory in the fellow citizens that there has been a very bad period where inflation was much too high. So it seems to me that we really have to be very cautious also in terms of political economy, of what we do in this respect. Now, I fully accept the idea that being too close to 0 is not good, And that's the reason why I am resolutely against those who are saying, and you have a number of very good economists, including coming from the BIS, for instance, the Bank for International Settlements, that are saying, we made a mistake, this fear of deflation was exaggerated, and we should accept that after all, we could say more than zero is quite a good definition of price stability, but not necessarily the two that I would say is incorporating a hedging against much too low inflation. So I don't say anything more than that at this stage. It seems to me that I have communicated something like an intimate conviction that something has changed at a global level during the recent period of time, that it is important, that we also have some lessons to draw from all that. And I would conclude now, because it's about time for me to conclude, if I understand. I'm at 1 hour approximately. Yeah, 5 minutes. Okay. So in this, let me only say 2 or 3 other things. First of all, the main lessons, I would say technical lessons, that we can draw from this period. I would say mainly the period of hesitation, what should have been, why we were waiting 6 months, and so forth. I already mentioned, of course, the fact that we have to improve modeling, strongly improve modeling. And that is something which I consider very important. Another lesson is that forward guidance has to be looked at very carefully. I can understand that, again, in the period of great danger of deflation, the idea that we would do whatever is necessary to get out of that situation, even if we have inflation coming back, we will continue to be accommodating. It seems to me that with the experience of, with the hindsight, it was not necessarily a very good idea, and that we should have said at the same time, of course this is valid in normal times, but if we have the sudden, I would say, appearance of emergence of exceptional circumstances, then of course what should be done has to be done in order to be sure that we preserve price stability. Another lesson that we might draw from what had been observed, I already mentioned that, the idea of linking very carefully in advance the conventional tools, namely interest rates, and the non-conventional tools, namely not only, of course, QE, but all the non-conventional tools, was a mistake. And that we better separate the two, because again, when you are linking them, you are making both, I would say, much less flexible than is needed in terms of very rapid transformation, very rapid changes. I already mentioned, of course, the modeling. Another lesson was that maybe we should prevent ourselves from reviewing drastically the monetary policy concept. Fortunately, there was no dramatic reviewing of monetary policy concept, despite the fact that there was a big debate in the academic world, as you could mention. The decisions which were taken immediately after Lehman Brothers in the US and in Japan were not put into question in the most recent period of time. So the 2% remains. And I would say the only small changes which were introduced in the monetary policy concept in the US as well as in Europe were something like we can accept periods of inflation above 2% during a certain period of time in order to compensate, to offset the period where we had a very low inflation. And that is part of sentiment that after all, and that was before the surge of inflation, after all, some kind of complacency vis-à-vis inflation had to be incorporated in the monetary policy, even if the 2% as a medium-term definition of price stability remained. And on both sides of the Atlantic, you can find something like that. Of course, when you had the dramatic surge of inflation, it appeared out of common sense, because the main problem was, so that it is clear that you should not modify things too much only on the basis of previous observation. But I don't want to criticize too much what was done, because it's obvious that they maintained the 2%. And I praise them for that, because then they are consolidating this idea that for market participants, investors, savers, and of course for the entrepreneurs and the union, the trade unions, they have in mind that there is an anchoring which has a lot of credibility, because it's been maintained over totally different period of time. The deflationary period of time, the surge of inflation period of time. So it gives a lot of credit. And so all taken into account, I praise the central bank for maintaining that. And of course, my main conclusion, but you heard that already, don't forget our fellow citizens. Let's not forget the most vulnerable, the most, I would say, poorest part of the population, those who cannot hedge against the inflationary taxation. And that is something which is certainly very important in the decision which was taken by all central banks that were, I would say, associated with this joint definition of price stability when they maintain this definition. So I will stop there, because I had exactly used my time, and thank you.